The average transaction price for new vehicles rose to a record $49,507 in December of last year.
This has always been an industry, and particularly for the Detroit car makers, where you've carried a lot of inventory that's led to carrying costs for you and your dealers.
The Federal Reserve raising by 1/4 point, by 25 basis points to a new range of 4.75 to 5%. It is the 9th hike in a row since the Fed began hiking in May.
42% of them said that their credit scores prevented them from accessing financial products, like credit cards or loans.
As the American economy struggled to contain inflation, it had a devastating effect on the car industry. In addition to credit card debt, households can barely pass car loans. However, in order to tame high prices, Federal Reserve has been hiking interest rates, which increased auto loan interest. And now average Americans have to pay for their car almost as much as they pay for their mortgage. This situation will force workers to choose between having a car or paying out a mortgage or credit card debt. As a result, being a car owner in the U.S. is more expensive than a decade ago. Prices are showing no signs of coming down as we head into the holiday season, said Rebecca Radulski, Research Manager of Economic and Industry Insights for Cox Automotive. So in this video, we're going to talk about surging expenses on car loans and their effect on the average household in the country. The issue is worth your attention, as according to the Federal Highway Administration, over 275 million personal and commercial vehicles have been registered as of February, and the industry employs over 3 million people, as reported by the Bureau of Labor Statistics. Thus, consider subscribing to the channel and hitting the notification bell so that you always stay informed on the most crucial economic trends in America and worldwide. As mentioned, inflation is the primary reason the U.S. economy suffers so much. To stop it, Fed Reserve hiked interest rates to a record high benchmark of 4.75 to 5%. However, data released along with the statement shows that 7 of the 18 Fed officials who submitted estimates for the dot plot see rates going higher than 5.1% terminal rate. So far, inflation has decreased to 6% in comparison to 9.1% in June, a 40-year record. In March, however, consumer prices stayed firm, challenging the Fed, and economists predict that inflation will be more resilient than one can expect, the article in Bloomberg argues. With such a dire forecast, the auto loan market has been put into mayhem. Although Fed's interest rates don't directly affect interest rates on car loans, their increase affects prime rates. Every time the Fed slams the brakes on the economy by raising interest rates, Americans shopping for a car may feel like they're the ones who will go through the windshield, says Sarah Foster, senior U.S. economy reporter at Bankrate. As a result, at the beginning of 2023, interest rates on new car loans reached the decade record of 6.46%. This type of loan is one of the most popular in the country and takes a substantial share of the family budgets. According to LendingTree, auto loan debt is the third largest debt category behind mortgages and student loans. Overall, Americans owe $1.52 trillion in auto loan debt, according to the Federal Reserve Bank of New York, accounting for 9.2% of American consumer debt. In January, Kelley Blue Book reported that the average transaction price of a new vehicle in the U.S. hit a record high in December at $49,507, an increase of 1.9%, around $930 from November, and up 4.9%, $2,297 from year-earlier levels. New vehicle inventory levels are increasing from historic lows earlier in 2022, but prices remain elevated. Thus, high interest rates on auto loans discouraging some buyers not to buy cars, which caused fewer sales. Because of this, the special deals offered during the holiday season for buying cars were not as good as they used to be. Even though people are less interested in buying new cars because of the expensive financing, the prices of vehicles that are being sold are still increasing. Research shows that 60% of people shopping for a new car are worried about affording it. JFK Auto Mobility says that buyers are choosing to take long-term credit because of surging car loans, while almost 50% of them are delaying the purchase by a year or two. Cox Automotive's data indicates that new vehicle affordability has improved in February, But the picture is frustrating compared to the last year or a decade ago. The average monthly payment peaked at $789 in December 2022. However, to put the payment in perspective, the typical American household can afford a car payment of around $400 a month, with an average monthly payment of nearly twice that. The new vehicle market remains heavily skewed toward the most affluent buyers, said Cox Automotive Chief Economist Jonathan Smoke. Furthermore, it should be noted that not only new cars are more expensive, but used ones as well. For instance, the new auto loan rate increased to 8.64% in February, while the used auto loan rate increased to 13.22%. And according to Conference Board, over a fifth of consumers, 22.8%, expect to spend more on motor vehicle services over the next 6 months. One of the problems that surging car loans caused in society is increasing auto loan share among young Americans. Since the end of 2019, citizens have taken more loans to buy vehicles than ever before. According to recent data, younger generation, under 40, eagerly takes loans to buy a new car more than the older generation. As a result, the amount of auto debt transitioning into serious delinquency is much higher for Gen Z and millennials. Throughout 2022, these generations saw $20 billion in auto debt called 90-plus days behind. Considering that young Americans are raking up their credit card debt faster than others, these types of spending can backfire for the future generation, as they will be forced to spend less, which may shrink the overall economy. Besides, it is not only that economy struggles. The cultural aspect of car ownership is changing before our eyes. Despite a fast increasing auto loan rate among the young generation, absolute numbers show they are losing interest in cars. If previously owning a car was a symbol of freedom for youngsters, the trend has shown a steady decline. A study published by National Geographic depicts a steep decrease in the share of teenagers and young adults who, compared to the peak in 1983 with over 72 and 92% respectively, drive less and don't own licenses. Moreover, just 80% of adults in their early 20s had their licenses in 2020, down 10% from 1997, as per Washington Post. So, there is a clear message to car makers that the industry is slowly dying, and if nothing is done to attract more buyers, the demise is guaranteed. However, as with almost all economic hardships, those with the least struggle the most. Already low-income households are falling behind on car bills. More and more people with low credit scores are struggling to pay for their car loans. This is happening because the cost of living has increased significantly in the past 2 years, and many government benefits that helped people during the pandemic have ended. People with subprime loans, loans with high interest rates for people with low credit scores, are significantly affected. When they can't pay their bills on time, they become delinquent. If they continue to be outstanding, they might eventually default on their loans and lose their cars. This is a critical problem because it shows that many Americans are struggling financially. In addition, as said, it's tough for people with low credit scores because they often have to pay more to borrow money in the first place. For example, let's take an average American family. Chris Martin knew he needed a bigger car as the birth of his 4th child approached, but he and his wife were already $14,000 underwater on their 2 vehicles. So the couple proposed an unusual 2-for-1 deal with an Atlanta area auto dealer in 2020, trading in both of their vehicles so they could afford a 3-row Ford Explorer. Their total loan after factoring in negative equity, a service contract, fees, and other costs ballooned to $66 on the $49,000 Explorer. Bloomberg writes in the article, car debt is piling up as more Americans owe thousands more than vehicles are worth. In the end, experts predict that owning a car will be more expensive for those who struggle to pay now. According to Bankrate Chief Financial Analyst Greg McBride, for most car buyers, those with average or better credit, rates will remain below 7% on new car loans and below 8% on used car loans, says McBride. But consumers with weaker credit profiles will have a much different experience as credit tightens and rates reach well into double digits. Overall, given the current economic condition, it is unsurprising that in 2022, fewer cars were sold in a decade. Industry estimates range from 13.7 million to 13.9 million new vehicles being sold last year in the U.S. a roughly 8% to 9% decline compared with 2021, and the lowest level since 2011, when sales were recovering from the Great Recession. Thank you for watching. Hit the like button if you enjoyed the video, and don't forget to share your opinion on the subject.